We gotta
I
we
don't.
gotta redo all of our witty banter.
I don't think so. We're gonna jump in.
We're gonna jump right in. Okay, let me just redo this part. Okay, welcome to Weekly Roundup, October 1st. We're just gonna jump right in. Ben, what happened in the week today? It was a good day today, it looked like.
It was a good day today. It was a good day in crypto today, of course, but it was a mixed day in the broad markets. We had a pretty nice, when I woke up this morning, futures were down and crypto was up. About half an hour before the open, futures turned around. I think some of it might have been on the back of Merck's news. So Merck announced that they have a tablet that you can take now if you have COVID, and it reduces the hospitalization by 50%, is at least the initial test. So I think that spurred a pretty positive change in tone after that announcement came out. From some of the virologists that I follow, seem to think this is the real deal, at least from the initial findings. So that's really positive, particularly in the US. So if they roll that out, that kind of turned things around. And then, midday markets were red. But as we come down into the close here, you see NASDAQ up about 1%, kind of all broad markets in the US up about 1%, and TSX closed slightly higher at up 0.4%. So volatile day in broad market, but crypto was strong most of the day.
Okay, great. If anybody has any questions, you know what to do. Q&A button at the bottom. You can raise your hand if you want to actually talk, or you can even put it in the chat button there. All right, well, what did you get up to? Let's review the week. What did you get up to this week as far as the portfolios are concerned?
Yeah, so it was a choppy September. I think coming into September, if we fast forward back a month, I thought we'd have a better month than we did. And the S&P closed down in local currency around 4.5%, I think, for the month of September. So that was really kind of the first correction that the S&P has seen of any material amount since last year. So that was a little interesting to see how that played out. There was a lot of short interest, like a lot of the institutions own puts and protection coming into September. So, we saw a bit of a sell-off recovery here, and it'll be interesting to see what happens in October. But, the present look is that most hedge funds, institutions are kind of underweight stocks right now and own a lot of protection. So couple that with kind of better numbers starting to come out from an economic perspective. Delta variant seems to be rolling over. The liquidity hasn't come out yet with taper. I'd expect October to actually be a little bit better than people, I think, expect. On the back of that, I'm not sure, but I think there's a lot of buildup of stock buying still ahead for October.
Gotcha.
Yeah.
So you often talk about the quads, right? So what where are we at as far as that's concerned?
Yeah, so I think it was either last week or 2 weeks ago I mentioned that, Darius Dale from Macro 42 and Keith McCullough from Hedgeye, they used to kind of see the world together when they worked together, and Darius went off on his own and has built his own firm. So this is the first time that I've seen when he's been on his own that he's got a different economic backdrop than Keith McCullough would. So Hedgeye has come in with their quarterly outlook, which they always do, and tend to preview what they expect in the next quarter. So they're expecting Q4 to actually be a quad of 2, which is what we saw in Q2 of this year, where you have kind of growth accelerating, inflation accelerating. You tend to get commodities, consumer discretionary, small caps, SPACs. So you get those asset classes performing pretty well. So if you look at kind of contrast that with Darius's outlook, is he thinks that we probably get that but his view is that we only get it for about 6 weeks. So we'll say to kind of mid-November is his picture on things. So he's raised a lot of cash in his portfolio, where Keith would have a different view that seems to indicate that he thinks Q4 will actually be that kind of that quad 2 outlook. One of the things we've discussed in the last probably 6 weeks is that we get this kind of convergence in the middle, right? Or we've got the economic, we don't have any deep kind of pivots in the economy. So we got a massive convergence in the middle. And so I think about it from the perspective is we probably don't get the same kind of quad 2 that we got earlier this year, because we were coming out of still depressed numbers. Year over year numbers are pretty weak, and so you actually had a pretty deep quad 2. So right now I'm lining up feeling like just like I said to you last week, where a cat on the stove. You're like, you want to be there, you want to participate, you're looking for where the opportunities and upside are. But small caps, SPACs, commodities, these are highly volatile asset classes. Crypto, like these things can swing, as you see. Crypto's up 10% today. So these are things that you don't want to overstay your welcome. So my view is let's participate there. I added to the S&P 500 this week, added to small caps and tech, and reduced exposure to some of the defensives that I bought a while back, which was Swiss francs, Japanese yen, INFL, which is inflation ETF. I kind of reduced some exposure to some of these defensive things and added to the risk there. Reduced some bond exposure a couple of weeks ago. I'm of the view that we get a bit of a reacceleration because that Delta variant has rolled over. But Darius described it that we're kind of maybe top of the ninth in this one. Keith doesn't use that kind of terminology, but when you think of the kind of the duration of this bull market from the February lows last year, we're probably near the end of it. You still want to participate, but you got to be much more cautious about what the other side of this looks like.
Right.
Yeah.
So are you leaning more in alignment with Keith's view or Darius's view?
I would say that I'm somewhere in the middle right now. Like I'm taking a view that I think that Darius is probably a little bit more specific. So he adds more kind of context around it, some fundamental thinking. And so, as we look at tapering, this liquidity coming out of the system, I think liquidity is going to be the major driver of what happens. So if the Fed starts to taper like they said they're going to, then liquidity is coming out. They're doing this kind of reverse repo, which I think I mentioned a little bit in the dailies there, where that's actually tightening liquidity. So if you get enough of these things where this cash is coming out of the system, at some point there's not enough buyers left in the market. Keith has a counter argument. There's $4 trillion in money market funds. Well, yeah, if people are going to start putting their money into equities, I would say late cycle, the likelihood of you see a big rush to stocks right now is pretty low. So, I'd lean more, I guess, towards Darius's view right now, personally.
Okay, no questions yet. You guys let me know. What do you think? Time for Ben's charts?
Sure, let's do it.
All right,
let me get the share screen up here. Just let me know when you can see it.
Ben's charts are live.
You can see it there. Okay.
Yeah.
So obviously,
nice and exciting.
Yeah. Yeah. So this is the PC deflator. So I talk a lot about inflation. Inflation and GDP are kind of the two major inputs into the economy. And so the one thing people don't always understand too is there's like what's the inflation number and what's the kind of that net inflation number once you've deducted inflation. So you got interest rates in the US right now, we'll say at 1.5, but we have inflation running at around 6, 5.5, 6 in the US. So you kind of got the delta that you see there where you're kind of minus 2.5 on an average basis. So this is the biggest deflationary, or the biggest kind of real inflation number that's this obscure since the mid 70s. So if we look back, kind of 74, 75 was the last time that it dipped this negative. And so this as a single data point isn't necessarily 100% the reason why you would make a decision, but it is something that you would say, let's pay attention to this number and what's a potential outcome. And as we start to see more analysts talk about, we could be in a 1970s kind of environment. And I don't necessarily think we are, but it's something that needs to come into the thinking, is that as we got into kind of 76, 75, 76, we saw stocks actually perform well for 1 year, but then we had kind of a prolonged sideways market in stocks, and we saw bonds get their butts kicked. So, in a traditional stock bond portfolio, and we head into this environment, there's potential that you could have 4 or 5 years of no to negative returns if that's the only asset class in your portfolio, stocks and bonds. So it's something that comes into the thinking when I'm looking at constructing the portfolios.
Gotcha.
Makes sense? Yeah.
Yeah, for sure. All right, on to the next one.
All right. This one.
Okay.
Yeah, so this is lots of questions. I'm starting to see lots of things pop up around real estate, right? And so as I think about the real estate market the last couple of days, I've teased out some charts on what's going on in Toronto. And if you saw today's chart, there's way more cranes up in Toronto than there is in like New York, LA, Chicago, at Las Vegas, like all the major centers combined. Toronto still has more cranes up than all of those major centers. And so, we're starting to see interest rates, start to move up a little bit, not materially, but up a little bit, which will put pressure on the housing market. And these things start to come up. And I look at this, like these are some of the articles that we see in the papers. And, I don't know if you've seen these things come across, but here's an example. They're talking about this guy, Peter, who makes $94,000. He owns 2 condos and wants to buy a third in downtown Toronto. Like these are the kind of things that are happening out there. There's no way on planet Earth this guy should qualify for even a second mortgage, let alone a third mortgage. But it seems like it's happening. I'm not sure what part of Toronto he lives in, but kind of the max mortgage he could qualify, assuming this was his actual income, is about $470,000. So when I look at these numbers, I think like there's a serious issue happening in the Toronto real estate market, and maybe it continues, but it's certainly something that I think is at risk right now, and really kind of grabs my attention.
Mm-hmm. In this case, right, they're probably using their equity as leverage against the other places, right? Because they gain so much equity so fast that they can use that as leverage. But yeah, if it starts turning, if the rental market goes and they don't have that cash, because their cash flow also counts towards their mortgage, right?
So they get credit probably for half the cash flow, like for the rental income of those properties. But even then, like if his income is actually 94,000, he's just not gonna. He just shouldn't qualify.
Yeah.
No, definitely not with the banks, anyways.
Yeah, it's crazy.
Yeah. Okay.
Well, yeah, it's interesting. That's interesting. Any question or comments about that, guys? Nothing. Okay. Got any other Ben's charts? Oh
no, last one. Last one.
Okay, we get 3 today. I like that.
Yeah. So we this El Salvador piece, and so I know we've talked about it a couple of times with Bitcoin, and so I think that the world continues, like the central banks and the banks are worried about the risks of this to the system, and it's a risk within the system. As we kind of peel back the layers, around why they did this, El Salvador. This is the reasons that that they've done this is that when you look at this is remittance inflow as a percentage of GDP. So this is basically when people leave the country, like if you're from El Salvador, you come to Canada, start working in Canada, what you do is you start to help out your family members. So you end up remitting money back to your home country. So obviously Lebanon and El Salvador would be top countries where this happens. And so as a percentage of GDP of money going back into these countries, into El Salvador, you get about $6 billion going back in there. And so, right now, as people are sending money back to El Salvador, it costs them on average. This is a global average. I'm sure the number is higher for El Salvador, but on global average, it costs them 6.83% to send that money back to their family members to help support them, and it takes on average 4 days for that transaction to happen. In order for the money to get back to their family members in El Salvador. And so, so the government in El Salvador says, what is a potential solution to give more money to the people of our country to help our country at the same time? And that's when they came up with the solution of Bitcoin. And so do you know how much it costs to transfer Bitcoin from one person in Canada to El Salvador?
Zero.
Right, zero. And do you know how long it takes?
Instant.
Yeah, exactly.
That's why it's gonna win.
So, and so as you kind of peel back and look at the reasonings and the rationale behind why they've done this, and all of these other countries you see listed on this chart are exploring similar types of things because of that very reason. They want to get more money into people's hands so they can help their people and help the country itself. I mean, it's a simple kind of rationale and thinking behind it. But when you think about it in this context, I think it gives you a little bit more understanding around why they made this decision, which appears rash on the outset. But when you look at the reasons behind it, it makes a lot of sense.
Yeah, exactly. Yeah, it's hard. When you put it that way too, right? It's hard to argue against it. I mean, if it costs zero and it's instant, right? Like that's all anybody ever wants, right? Those are the two biggest values you can give somebody.
Yeah.
Right. Time and money.
Right.
It's all,
Yeah.
Because even we mentioned before, like if we even with all the systems that we have now and everything, we make a trade, everything's, or we want to move money, it's T+2 still, right? And you were saying just till recently it was T+3.
Yeah.
Right. So it takes 2 to 3 days anytime we try to move money around, right? Within reason. There's obviously some exceptions to that.
Sure.
But it's crazy. And then when you have something like this on the blockchain that's instant and is for free, it's certainly going to be a game changer.
Yep.
It already is in El Salvador, right?
Exactly. So those are the charts. Those are the charts for the day.
Ben's charts, just crushing with those. Okay, well, let's have a zippy what you got coming up next week, and we'll wrap her up.
Yeah, so it's good tone to the markets today. There was increased volume, so I'll continue to look and see if that continues on. We do have a pretty busy month. There's debt ceiling discussions. We got more taper talk coming. So all these things will play into the month of October. So I'll be watching that. The new issue market seems to still be pretty healthy. So quite a few issues came to market this week. A couple of perpetual preferreds have traded pretty well that have come out as well. So I'll be interested to watch that and see if things continue in that space. But it's more I start to pay attention to, if we get these kind of moves up where we could get a 4 or 5% increase in broad markets, I think that would be an opportunity to look to head to the exits and a bunch of things. But continue to watch the flow of money, watch that the 10-year bond yield where we kind of touch that 155 level, kind of the 160 to 170 is probably the top end of that range. So if we get an equity rally and bond sell off to that level, that's probably a point where you got to think about rebalancing to a bit more safety. So those are the things I'm thinking about for next week.
Okay. Nobody's very chatty in the chat today.
Hmm.
So did you have anything else you wanted to cover before we wrap it up and head out for the weekend?
The only thing I think that's grabbing a lot of attention is this inflation narrative, and so I'll continue to watch that as the supply chains and inflation. I'm trying to understand still what's happening within the supply chain, and ultimately where there's one hand you look at this is a positive from an inflation perspective, so you want to own some of those assets. On the other hand, that's got to cause cost pressure, and it's got to put pressure to the downside on GDP. So trying to really balance those two between, is this supply chain pressure short term, or is this something we're going to be living with for next year and a half? So spend a lot of time trying to understand that, but that's kind of the last thing I'm thinking about on Friday here.
Good. Yeah, that's exactly the last thing I was thinking about too. All right. So what's on tap for the weekend?
Sports, hockey practice tonight, couple of soccer games. You?
Same.
Yeah.
Yeah, practicing. We're at Sensplex.
I am at Sensplex tonight, 9
Oh,
o'clock.
me too.
Okay.
Oh, 9 o'clock. I got 6
Yeah.
to 7:30. So
Nice.
won't see you there.
Oh.
All right. Well, enjoy the weekend. Hopefully the weather's nice, and we'll see you next week.
Sounds good. Thanks. Take care.
Bye.